Thank you very much, first and foremost, to Zafar Masood Saab, to the Pakistan Banks Association, to Atif Bajwa, and to all of you for inviting me to share my thoughts. I'm going to talk about global macroeconomic prospects. So it's been a tough decade for the global economy so far, and we're only 2/3 of the way into it. First, we were greeted with COVID and the after effects of that. As we were struggling to come out, the Ukraine war happened, and what ensued was a spike in global energy and food prices. As we were recovering from that, the Trump tariffs were launched, and a lot of uncertainty and angst ensued. And now, a year after that, the Iran war happens. So the global economy has been rocked by a series of shocks this decade and is truly in flux. 4 months ago, when the US launched the war on Iran, there was heightened concern about the severe impact on the global economy that the war could have, and especially on this region, where, of course, the war was centered. The IMF, coming out with its forecast of the global economy, it does 2 or 3 or 4 a year, on a regular interval, released its next forecast about a month after the war started, and it marked down the global growth forecast, even in what they called the best case scenario at that stage, and noted that much worse outcomes were possible given the magnified uncertainty that prevailed. 4 months ago, the outlook for Pakistan in particular, when the war started, looked even scarier than it did for the globe as a whole. There were strong parallels with 2022, of the time of the Ukraine war. First and foremost, oil prices had jumped by almost the same order of magnitude as we saw 4 years ago. Coincidentally, reserves 4 months ago were at about 16 billion, exactly the same level that it was when the Ukraine war started. Back in 2022, within 6 months, reserves had halved to 8 billion, and a year later they were down to 3, and talks of default were rampant. This time around, reserves were again at 16 billion, so clearly there was concern. What is going to happen? Are we in for a replay of 2022? So thankfully, not only for Pakistan, but for the world economy as a whole, the most adverse scenarios have been averted, at least so far, but risks remain magnified. I will review the latest outlook and discuss those risks as identified by global institutions such as the IMF and the World Bank, highlighting the ones I think are probably the most key as of now. I will, in addition, talk about 4 powerful structural factors that are adding to the global economic flux, in my view. And those are what's already been talked about a lot this morning: artificial intelligence. In addition, I will talk about what's the subject of this slide, but related to this, the energy transition and the quest for energy security. The third structural flux factor, as I call it, that I'll talk about is immigration and demographic forces that are unleashing their effects on the global economy and will continue to do so in the coming decade. And then the last flux factor that I will spend a little bit of time on is geopolitics, related trade barriers, and the shifting US role as the leader of the global economy and of global economic institutions. I will go over how these factors might interact with each other. For example, I'll go over how we know that artificial intelligence affects employment, the prospect of unemployment, and how that might have potential to affect immigration policy in countries. Artificial intelligence and data centers also affect the demand for energy, and therefore the energy transition and the need for energy security, as perceived by many countries. All this, of course, also plays into domestic politics and geopolitics and international relations, as we are already seeing. So after talking about all those things, I will discuss the implications for the Pakistani economy. So let me turn now to macro prospects. The latest World Bank prospects for the global economy came out just last month. The latest IMF forecast came out in April, as I mentioned, about a month into the war. There is an update coincidentally coming tomorrow, but we'll have to wait until tomorrow to learn more about it. I imagine it will look like a lot like what the World Bank had to say in June. So first, the IMF forecast in April. It was prepared a month after the war started, so it was still very uncertain how things would go. They already marked down global growth by 0.2 percentage points relative to their January forecast, so in just 3 months. 0.2 is a relatively sizable revision in that short a span of time. What was important was not just the downward revision, but also its comparison with previous decades. So global growth in this year was forecasted to be 3.1%, which compared with 3.7% average, so a half a point less than the first 2 decades of this century, and even a quarter point less than the previous 2 years. So the story was both the downward revision due to the war, but also the sluggishness compared to history. For emerging economies in particular, the impact was expected to be larger, almost a half percentage point. And for the world as a whole, they felt that the headwinds that had been unleashed from higher trade barriers and trade policy uncertainty were being broadly offset by tailwinds coming from AI, mainly AI-related investment, and continued accommodative financial conditions. There was fiscal and monetary policy support continuing from in advanced economies. The IMF also at the time came up or elaborated on what they called an adverse scenario. So if, remember this is 3-4 weeks into the start of the war, they wanted to ask the question, what if things go badly from here? What might happen? And their worst, or this adverse scenario, had much, much lower growth. So growth would be halved to just 2%, with inflation jumping to 6%. Thankfully, so far at least, the bad scenario has been averted. Specifically, the wider energy dislocations that would have accompanied such an adverse scenario beyond what happened in the first month or so of the conflict have not happened. Thankfully, inflation, though it has gone up, has not resulted in a de-anchoring of inflation expectations. Thankfully, the tightening of global financial conditions that could have happened has been avoided. Indeed, equity prices in many of the major markets, especially in the United States, are at record highs, and frontier market spreads for borrowing are at record lows. Even countries like Congo, Angola, Cameroon are seeing their spreads down to 100 to 300 basis points, a record for them. Even oil importers saw their spreads tighten, even though the war meant that their balance of payments would deteriorate. So, of course, all this has been so far. The risk of re-intensification remains, but hopefully, inshallah, we are past the worst of it. Now, just a few words on what the World Bank had to say. Broadly the same things in their latest forecast. They've actually reduced the downward revision since January to just 0.1 percentage point for the globe as a whole. But they continue to say that emerging markets in developing countries will be affected rather more, advanced economies almost not at all. Their bottom line is similar to the IMF, that there's the war impact has been offset by the positive momentum coming from artificial intelligence investment and from good performance going in the lead up to the war. Now, both institutions, and I think many global economy analysts point to a number of risks, and let me just outline some of the key ones. So first, wider geopolitical tensions, including energy price disruptions proving more long-lived than we are expecting for now. In addition to the direct supply side effect, you saw the oil price chart earlier, so a reversion of oil price highs, but then in turn that would push up inflation and prompt a monetary policy, a much larger monetary policy response akin to what we saw in 2022 and 2023. That in turn could deflate these rich asset prices that we're seeing and have an impact on global liquidity. As I said, so far at least, that looks to be not the likely scenario anymore. Another risk that has been identified is reduced fiscal resources and higher reconstruction and security-related costs, especially for the Middle Eastern countries that have been most affected by the war. So in this reconstruction and so on, this could translate into Gulf oil exporters drawing down their external wealth, which in turn could raise real interest rates in advanced markets and result in some tightening of financial conditions. Something to look out for going forward. Yet another risk that's been identified is the possibility of trade disputes flaring up further, including issues related to supply chains, critical minerals, rare earths, and last but not least, an important risk that's been flagged is a revaluation of AI profit outlook. Right now, AI firms are very richly valued. Perhaps those valuations can be sustained, but there's also the possibility that both AI investors as well as those financing AI could be prompted to reconsider the profit outlook and thereby reconsider those flows. Now, these risks that I've just outlined nicely set up what I would like to talk about next, which are the structural factors contributing to the global economic flux. So the first one that I'd like to turn to is the effect of artificial intelligence. Now, of course, it is a powerful catalyst for growth for the global economy, which is already experiencing a structural slowdown. In the short term, artificial intelligence boosts the economy mainly through higher investment. Much of that investment, of course, almost all of it is happening in advanced economies, much less so far in emerging markets. Over the longer term, though, it will not be the investment in AI infrastructure, but the productivity that comes from adoption of AI that's going to be a much more powerful catalyst for longer term growth. How much, of course, is a key question, and it is much debated. What this chart which the World Bank put together surveys the literature, and as you'll see on the left side chart, the range of expectations regarding AI is quite large. That's the whisker in the third column. So almost ranging from almost nothing at all to even more than what the advent of electricity contributed to productivity. So very wide. And when they take those productivity numbers and put them into what that might translate into in terms of global economic growth, they have various scenarios. So I will focus your attention on the very last column on the right-hand side, which is the 2030s. This is when the productivity enhancements coming from widespread AI adoption will start to kick in. So it could range from AI being the red bar, the lowest of the three, corresponds to a relatively what they consider sort of the median forecast of AI productivity increase. So even then, it will match the middle decade, the 2010s, in terms of growth performance. And if you, in their higher, sort of more optimistic scenarios of the productivity coming from AI adoption, growth could actually be the best we've seen this century. I think it's important to recognize that this will be, of course, at the aggregate global level. AI adoption in advanced economies is proceeding much faster. Emerging markets in developing countries will, of course, also ride the wave, but the impact will be differential. And there, the World Bank and others emphasize that those who will benefit the most will be the ones with the most capacity to invest. And those with the least capacity to invest risk getting left behind. I will say that again for emphasis. Those with less capacity to invest risk getting left behind. I will come back to this when I discuss the implications for Pakistan. Of course, AI also has the potential for severe labor market disruptions. As AI starts to replace labor, will labor become redundant, or will labor move to other sectors? And that is an issue that's being kicked around and debated quite a bit. Again, I will come back to that in a moment. Let me first quickly do a sidestep, talk about the second structural factor that I mentioned, and that is energy. AI, of course, has resulted in a very large demand for electricity, which in turn has helped sustain oil prices a bit even before the Iran war happened. But as I'm going to see if I can go back. As this slide had indicated, oil prices were on sort of a downward trajectory ahead of the war. The fact that the run-up during the Iran war, when 20% of global oil trade was closed off, was only as large as the 2022 shock, was a little bit of a surprise. Market analysts almost universally were talking about $150 and $200 a barrel oil. It didn't happen. The fact that oil prices have collapsed as quickly as they have, without yet a reversion to pre-war flows of oil through the Strait of Hormuz, is also a little bit of a surprise. It may be signaling that there is a structural shift happening in the energy market. Whether that structural shift will be offset by increased demand, by AI data centers and so on, remains to be seen. But for the moment, there may be some further downward momentum to be had. In fact, there was a very recent acknowledgement in The Economist magazine about how they got oil price predictions wrong during the war. I think many oil market analysts feel that way. Nevertheless, the energy market continues to have the potential to create great instability, as we saw, and therefore energy security remains sort of very much on the global agenda. Let me move next to another key AI-related aspect, which is labor and some of the underlying forces affecting global labor markets. And those have to do with demographics and migration. So unemployment is already starting to rise in many advanced economies. In the United States, for example, coders and software developers are being laid off in pretty large numbers already. Anti-immigration sentiment, which had already picked up well before even this decade started, has really continued to mount, and you are seeing, or the global economy is seeing that in movements in population growth rates. So, for example, the black line, which is the United States, saw a very rapid growth in population that was all migration related ahead of the latest election in 2024, and then since then, a very sharp decline. These kinds of pressures, I suspect, will continue, but what I'd like to really point to is the slowdown in population growth in pretty much everywhere except in some countries, Pakistan being a notable one, and sub-Saharan Africa. And to a lesser extent, in the Middle East and North Africa. In Latin America, in Europe, in the United States, in East Asia, population has slowed to in many cases below replacement rate. So population is shrinking. This may give rise to new pressures going forward relating to migration policy. Eventually, if AI is not able to replace labor, then it may, at some stage in the future, maybe a decade or 2 decades hence, it may give rise to more liberal migration in order to accommodate need for caring for aging societies in some of the advanced economies. Let me move now to the last structural factor before turning to Pakistan. Geopolitics and trade fragmentation have been very much in the news ever since the Trump trade tariff announcements of April 2025. All the flux factors I mentioned before are further feeding into trade policy and trade frictions. For example, migration pressures, competition for AI supremacy, competition for energy security are all contributing to trade frictions. Lately, some better news: the US Supreme Court ruling against the Trump administration's across-the-board trade tariffs, for example, have been helpful. And in fact, those were one of the factors identified by both the World Bank and the IMF, providing a little bit of a tailwind, offsetting the headwind from the war in terms of growth momentum in the first half of this year. In fact, in this chart, in the blue line, you already see some a reduction. This, by the way, is effective tariff policy rates in the United States. So some reduction in that already happening due to the Supreme Court announcement. But if one thing is still true, if there is one thing that's still certain, that has to be that trade frictions or trade policy will continue to face heightened uncertainty. So what does this all mean for Pakistan? So first, in the near term, the crisis has certainly been averted. Petroleum imports, at least in the month of April, that's the latest data I was able to see so far, did expand or did jump by $1 billion in just that month, $1 billion additional in just that month. But reserves, thankfully, have held up at the 16 billion or so level, and we heard the minister say that they're expecting it to rise to 18 by the end of June. Those numbers I don't think are out yet, but that is certainly one big relief. Two silver linings, one of which the minister mentioned, have also emerged. So I also recall reading some time ago that activity in the Karachi port in just the first 25 days of March exceeded the whole previous year. So to the extent that some of this diversion of trade can become permanent, there is a silver lining for Pakistan. Another silver lining for Pakistan potentially has to do with the reconstruction activity that will go on in the Gulf generally, possibly in Iran itself. And if further down the road, Iran starts to re-enter global trading relationships, Pakistan, as a neighboring economy, is well positioned to try and be closely involved in that. So two small silver linings in the short to medium term, I think. But over the longer term, which is beyond the next year, 2, 3, the flux factors that I've outlined will remain very important. So how should Pakistan, or how will Pakistan have to navigate through those factors to become a prosperous economy? So I think first and foremost, the population growth chart that I showed, Pakistan will have to address this very high population growth rate. It has huge implications for employment or unemployment, and that in turn will hold back prosperity if not addressed. I spoke a lot about that last year, so I will not delve into that any further. Now, in addition, even though the impact of AI investment vary. As I said before, everybody agrees that in order to take advantage of AI, investment is needed. We also need, Pakistan does, to invest to manage the energy transition and climate change. We need investment for security in this globally fragmented world. Not just military security, but also security of supply chains. Yet, our investment rate, sadly, lags very, very far behind. So I wanted to look at how weak was Pakistan's investment. And I knew it was weak. What I didn't appreciate is just how weak compared to everybody else. So I knew that it would be unfair to compare Pakistan to advanced economies. So I looked only at emerging markets and developing countries. I thought it would be unfair to look at data for small island countries or countries with population of 1 or 2 million, so I took those out. And then obviously I didn't have data for countries torn by war and that sort of thing. So everybody else that remains, 50 or so countries, I am sorry to say, averaged over this decade that we're in, Pakistan is dead last. Dead last. There are 2 countries for which I couldn't get data. This is from the World Bank Development Indicators database. But for everybody else, dead last. Now, with investment rate like this, it will be very difficult to ride the AI adoption that is necessary. It will be very difficult to navigate the flux factors going forward. Now, what causes such low investment? There's a whole host of factors. Pakistan cannot invest if there is little saving available, and there's very little saving available. That's because of the demographic structure of our population. I talked a lot about that last time, so again, I won't go into that. In addition to saving, though, there's lots of other factors, both structural as well as macroeconomic. Rates of return, both on saving and investment, are low. There's a lot of competition for funds with the government. That's a problem. There are business climate issues, etc. So any and all of these factors are also faced by the other 50 countries. Yet Pakistan has done poorly. Related very closely to the low private investment is the flip side of that, which is private credit to GDP. Again, Pakistan here is not an absolute last, but very close to it. Intermediation of saving into investment is clearly important. It is not the cause, but it reflects, so low private credit is not the cause of low investment, but it reflects some of the same factors that hold back investment. So I'm really looking forward to a discussion over the next 2 days with this audience, how to catch up in terms of private credit. Zafar Saab, I know that you have made a lot of progress in the last 2 years, but there's a very long way to go. So in case there's any doubt between the relationship or about the relationship between private credit and investment, I think this chart captures it. And if you take out the 2 outliers, Tanzania and Algeria, which have somehow managed high investment without private credit, this relationship would be even steeper. I think I will end it here, and thank you very much. I look forward to trying to understand and see how we can invest.